I want you to prove to yourself for your own brain so you can have aha. I mean, when I explained that to you, you took that as for granted. You are getting somebody's money, $100,000, Myung's money, and you promise to him, I'll pay you 12% each year. And of course, I'm going to give you back your principal 5 years from. And he's fine with it because he's satisfied with 12% return. He's satisfied with 12% return. Nothing else he needs from me. I mean, so safety, risk. I don't run away, or I don't die before then, or whatever. But that non-financial risk factor, put it aside. Financially, 12% promise. I keep the promise with a periodic interest payment. I kept the promise by returning his principal back. Fine. So I also prove that to you. Present value at the same percentage. At the same percentage. Contract rate is same as the market rate. And I compute it using the table or calculator or internet website, whatever you have. Converting into, we call this discounting, future cash flow into today's present value. Why I call that bonds pricing? Because you are issuing bonds at how much? Pricing. Right? So I've been showing you this slide many times, right? I'm going to talk about all these later, types of bonds later. So I've been saying this many times. Selling price of bond today equal to present value of future cash flows promised by the corporation, discounted by using the market interest rate. So my example, I'm using example intentionally at 12%. First, what's going on? Okay, 12%. So market rate is 12%. Market rate. Because bonds are issued at the market, so we have to go by market. Market rate is only relevant rate, not the contract. Contract rate, yeah, state rate is what? You use the contract rate for what? To compute
the return.
Interest payment. But remember, bonds are traded in market. Bonds are issued in market. So it's a bond pricing is a function of market interest rate going up and down. Remember we talked about that? Market interest rate going up, bond price going down. Market interest going down, bond price going up. Inverse relationship. We talked about that last week. So, anybody? What I just explained to you, 100,000. I proved that to you. It is called bond. In this case, bonds issued at. Can you complete my sentence?
Face
bonds
value.
Are issued at. I know.
Face value.
Yeah, face value. Bonds are issued at face value, or bonds. Some textbook call that bonds are issued at par. At par. At par. Sounds like we play golf or something. You play golf at par 3. Right? So this is your textbook PowerPoint slide. Assuming contract rate is 8%, if its market rate is 8%, the same percent, my example is 12%, 12%, face. Okay, so since you have this PowerPoint slide available, I just want to come back to this quickly. So at par, at face, journal, face. So journal entry quickly, January 1.
Debit.
Somebody? And?
Debit cash.
Debit cash. How much? Well, and sounds like a male person. Right? And he's waking up now. All right. every year.
Bond interest expense.
Okay. Credit.
Credit cash. Okay.
How many times?
5 times.
Dido, right? And then 5 years later,
Debit bonds payable.
so that's the birth of the bond, life of the bond, death of bond. We finished chapter 15. Let's go home. Why is chapter 15 so hard?
More to it than that.
We're going to do like this now.
Yeah, I wish that's the end of the problem. End of the issue I'm talking. Right? Then chapter 15 should be one-page chapter. Should be easy. We don't have to worry about time value of money that much because it's already given. But remember, this scenario is only when your bond certificate, pretend this is bond certificate says 12%. You already printed it out to the world, right? Who prints this out? Underwriter. Who are underwriter? Morgan Stanley, JP Morgan, Goldman Sachs. These are the investment banker underwriter. They are helping what? Who? Ford Motor Company, Intel to issue bonds because they are the manufacturer. They are not in business of lawyers and accountants. They don't have that, right? So they print it out already. But is the market rate same as your printed interest rate? Probably not.